The news day continues here on One News Now Business. I'm Diego Castro. Here are the biggest stories on the economic and corporate fronts. The Philippines saw its budget deficit widen in September after revenues posted a double-digit contraction. Data from the Bureau of Treasury saw September budget deficit at more than 250 billion pesos, up by about 71 billion pesos year on year. That puts the year-to-date budget gap at over 983 billion pesos, which at least is lower than the same period last year. Budget deficit is when government spending outpaces revenue and other income streams of the state. Underspending is also seen as a factor for the slower growth in the second quarter. Economists have cited the need to ramp up fiscal spending to support economic activity with consumers and businesses bogged down by high inflation and interest rates. Speaking of interest rates, the Bangko Sentral is considering an off-cycle hike in interest rates within the week. BSP Governor Eli Remolona says they're looking at the data, and if there's enough inflationary risks, they may consider hiking rates as early as today or next week. The next Monetary Board policy meeting isn't until next month, November 16, although the BSP had earlier hinted on a hike after keeping rates unchanged since March this year. Socio-Economic Planning Secretary Arsenio Balisacan suggests that further interest rate hikes may not be necessary to combat inflation, as they attribute it to supply-side factors. Balisacan emphasized that high interest rates have negative long-term effects on the economy and that these could discourage investment. He anticipates a decrease in October's inflation following September's 6.1% print. He cites the harvest season and falling global rice prices as drivers of a potentially slower inflation. However, he still raised concerns about El Niño's impact on rice production, as well as the potential for rising domestic oil prices due to the conflict in the Middle East. Despite these, though, the NEDA chief remains optimistic about achieving the Philippines' 6 to 7% GDP growth target. Let's get more insights on that from Ronilo Balbieran, member of the Faculty of School of Economics at the UA&P. Good morning, sir. Thank you very much for joining us again here on One News.
Morning, Diego.
Okay, sir, let's get right to it. Now, is a rate hike necessary, or do you agree with NEDA Chief Balisacan?
Well, I agree with the NEDA Chief Balisacan. No? So because last year, there are two factors, supply and demand factors. So a rate hike is a no-brainer.
Okay.
But this time, with our slowing GDP growth, especially 4.3% in second quarter, no, the factor for inflation is now being sourced from supply side issues. No? So there's little effect in relation to a demand side intervention of our inflation, where we already know with the slowing growth of our economy, and you need more supply, you need more income, you need more production, and higher interest rate may actually be damaging over the next 12 months to 18 months.
Yeah, but sir, do you see the budget deficit then improving at least this year?
The budget deficit may not be a concern at this particular moment, especially for third and fourth quarter, because we want government to ramp up spending, especially on infrastructure and government spending. So because a large part of our second quarter GDP was actually because of the slowdown from infrastructure spending of the government. So you need government to actually ramp up spending. So you may not want to be so addicted to a very narrow budget deficit, but not more than 5% of GDP may be acceptable. But I think the concern now of the entire economy is our third quarter and the fourth quarter GDP growing faster than inflation, because we will have more or less a very much substantial decrease in our real income if our GDP keeps on decreasing and our inflation keeps on increasing.
Okay, and let's talk about now oil prices and the war between Hamas and Israel and the thought of a possible intrusion of Iran into this scenario. Now, do you see this making a huge impact on oil prices and the overall situation of inflation?
Well, number one, as I mentioned in the inflation front, a large part of our inflation is actually caused by food, especially rice, which
Okay.
accelerated at 14-year high at 17.9% rise inflation, and our food inflation is at 9.7%. So a
Mm-hmm.
large part of that is, I think, growing our supply base. No, as our NEDA chief mentioned that the harvest season for rice is now ongoing. So therefore, we should expect less pressures on prices of food. So I think the only impact of that particular conflict to our
Mm.
economy is on the price of oil. But I think this has already been embedded already with the conflict of
Okay.
Ukraine and Russia. So there's little already little additional impact on our economy, if ever.
And all things considered, what would be then your outlook, your inflation outlook for the year, and target to be reached by 2024?
I think the target for 2024 can be reached. Well, that's why it will be a very delicate balancing
Mm-hmm.
act of the BSP today and the entire 2 months, because we are just feeling the impact of rate hikes last year.
Okay.
And I believe that a part of our slowdown of our economy was because of that rate hike. So we have slowed down our investments, we have slowed down our production, and so an additional cycle of rate hikes will have impact on our projections of our inflation and GDP growth by next year. No? So we originally forecast 6% for this year,
Mm-hmm.
but it's now becoming very difficult to achieve at this pace that we are going, at the inflation rate we are going. No?
Okay.
So I still believe 6% is still possible.
Okay.
Subject 6% for this year still possible if we see that the third quarter GDP has significant increase in government spending and government infrastructure spending. Otherwise, we can only expect less than 5% within the year, and perhaps a combination of factors, rate hikes,
Mm-hmm.
and series of supply driven shocks. We can expect 5 to 6% for 2024. But if we see already signs here of recovery in our infrastructure spending for third, and it will be continued for the fourth quarter. I think a 7% is still possible for
Okay.
2024.
And now we're in the middle of a campaign period for the barangay elections, and holiday has just begun the Burr months with all money going around. Do you think now this will help boost growth in the second half? 6 to 7% target, is this achievable, or should this be revised?
Uh, I am monitoring the infrastructure spending and
Mm.
government spending for July, August, September. And I think the growth rates are double digits. And so I'm quite positive that this should translate to our GDP numbers by the third quarter. And
Mhm.
so that will actually change the ball game of our forecast for 2023. So
Mm,
I,
okay.
I, I certainly pray that these double-digit reports on the disbursements of budgets of government, especially the local elections, should be able to help circulate economy, accelerate the programs of the government, and
Mhm.
then our holiday economics next week should be able to turn the tide in terms of higher
Mhm.
GDP growth for the entire year, and therefore that will change everything for our 2024 forecast.
And what other measures do you think should the government or can the government implement at this point in time to boost economic growth?
Well, we've seen efforts, different accomplishments by the different government agencies in terms of digitalization, in terms of e-commerce, in terms of e-government. I think we highly expect, for example, that the Internet Transactions Act be signed by the president very soon, because it
Mhm.
has been approved by the House of Representatives and the Senate and the BICAM. So it should be signed very soon, together with the public-private partnership code. So these things, when signed as soon as possible, we're just talking about weeks, if
Yeah.
not 2 months, then this should be able to invite more investments, both foreign and domestic investments, and to really ramp up production. So what we are dealing with, the most important problem of our country now is GDP growth,
Okay.
income and production growth, and that should actually minimize the impact of inflation on the purchasing power of our people.
As always, very good insights, and we hope to have you again on the show. Thank you very much, Ronilo Balbieran, member of the Faculty of School of Economics at the UA&P. Good morning.
Thank you very much, Sir Diego.
We'll be back with more stories after the break. Keep it here on One News. You're still watching One News Now. I'm Diego Castro. The government plans to secure 225 billion pesos from the local debt market in November. The government jacked up its borrowing program by 50% from October, even as interest rates are expected to continue to increase. The Treasury Bureau said it would auction off 15 billion pesos each in T-bills for the 4 Mondays of November and in October for a total of 75 billion pesos. The short-dated T-bills will be offered at 5 billion pesos each, which benchmark tenors of 91, 182, and 364 days. The Treasury also plans to raise 30 billion pesos each in T-bonds for a total of 15 billion pesos. The T-bonds to be offered on 4 Tuesdays of November and 1 in end October will have maturities of 5, 7, 10, 15, and 6 years respectively. The country's infrastructure cooperation with China seems to be showing cracks as the Philippines drops Beijing as a funding source for the Mindanao Railway project. In a letter, the Finance Department informed the Chinese embassy that it is no longer inclined to pursue official development assistance from Beijing for the 83 billion Mindanao Railway Phase 1. The letter, signed by Finance Chief Ben Jokno, made no mention why the DOF is withdrawing its loan application. The railway project's construction was slated to begin in 2019. However, it has been put on hold since China has failed to get back on the loan. The Transportation Department earlier said it was already exploring other options for the funding of the Mindanao Railway. The government expects to secure a new financer for the Mindanao Railway Phase 1 within the first quarter of 2024. The Philippines and the European Union have inked a 60 million euro financing deal for the Green Economy Program. This is part of the EU's Team Europe initiative on green economy, with the aim of helping the Philippines transition to a sustainable economy, as well as reduce greenhouse gases by 75% by 2030. The funding will support waste reduction, renewable energy, deployment, and improved energy efficiency. The EU will work with the Philippine government, local authorities, and the private sector to promote green investments and sustainable supply chains. The European Commission is also exploring the possibility of a free trade agreement with the Philippines. And those are the top business stories of the hour. I'm Gov't Castro. Join us again at 2 p.m. We are One News. All sides, all the time.